All right, if you've ever wanted a trading tool that just cuts through all the noise, one that focuses purely on price to catch those big, explosive market trends, well, you are in exactly the right place. Today, we're doing a deep dive into a legendary, time-tested indicator for mastering breakout trading, the Donchian Channel. Let's get right into it.
So here's our roadmap. We're going to start with the mind behind the method. Then we'll break down the channel itself before building our go-to trading playbook. After that, we'll level up with some advanced setups, and finally, we'll get into the two most important things for success, risk and psychology, before putting it all together with some real-world examples.
You know, to really get why this indicator is so powerful, we have to go back to where it all started. This isn't some new, flashy strategy that just popped up. It's got a deep, proven history.
And this is the man himself, Richard Donchian, who is nicknamed the father of trend following. And this quote, it captures his philosophy perfectly. He believed your main goal should be to make money, not to become an expert at reading a balance sheet. His thinking was revolutionary because it was so simple. Just focus on what the price is actually doing, not what some fundamental report says it should be doing. For him, price action was absolute king. And the power of his ideas? It was proven in one of the most famous trading experiments of all time. You've probably heard of them, the turtle traders. They took a group of total beginners, handed them a set of mechanical, trend-following rules based on Donchian's work and, well, turned them into trading superstars. It showed without a doubt that a solid, rules-based system could actually be taught and copied successfully.
Okay, so let's get practical. Let's pull up a chart and break down exactly what we're looking at when we use Donchian channels. It's really just made of three simple but incredibly powerful lines.
So first up, we have the upper band. The easiest way to think about this is as a price ceiling. It literally just marks the highest high the price has hit over a certain period, say the last 20 days. When price breaks above this line, it's a really big deal. It means buyers have just smashed through that recent ceiling and are pushing into new territory. And you guessed it, on the flip side, we've got the lower band. This is the price floor. It marks the absolute lowest low over that same 20-day period. So when the price breaks down below this level, it's a huge signal that sellers are firmly in control and are driving the price to new lows.
And right there in the middle, we have the middle line. Now, this isn't just a simple average. Think of it as a momentum checkpoint. In a really strong uptrend, you'll see the price just keep bouncing off of it, holding above it. And in a downtrend, it acts as resistance, keeping the price below it. It's an awesome visual guide for the trend's health. Okay, so we get the parts. Now let's put it all together into an actual strategy we can use with a clear, step-by-step set of rules. This is where the theory becomes a real trading plan. Step 1, you're looking for the bands to get really narrow or go flat. This is consolidation. It's like a spring coiling up with energy. Step 2, and this is absolutely critical, you have to wait for a candle to close outside the channel. A little wick poking out doesn't count. Step 3, you need confirmation. Is there a big surge in volume backing up this move? Is an indicator like RSI showing momentum? And finally, step 4, you pull the trigger with a clear entry and a pre-planned stop loss. So that classic playbook is a fantastic starting point. But let's be real, not all breakouts are going to be winners. So now let's look at how we can refine this strategy, filter out the bad signals, and find those really high-quality setups. The first choice you really have to make is about your entry style. You can be aggressive and jump in the second that candle closes outside the band, which is great for catching those rocket ship moves. Or you can be more conservative. You wait for the breakout to happen, and then you enter on the first little pullback to that broken band. This usually gets you a way better entry price and lets you set a much tighter stop loss. Now, to avoid getting chopped to pieces in a messy sideways market, we use filters. First, a simple trend filter, like a 200-period moving average. Prices above it, we only look for longs. Easy. Second, a momentum filter. Is the RSI also breaking out? That confirms the move has real strength. And finally, a volatility filter. You want to see those bands squeeze together really tightly before the breakout. Those are often the most explosive moves. So we've got the strategy, we've got the filters, but honestly, none of that matters without this next part. This is the stuff that separates traders who have a cool system from traders who are actually consistently profitable. This right here lays out a simple but totally non-negotiable risk plan. Your stop loss has a logical place to live. For a long trade, that's usually just back inside the channel, maybe below the middle line. Position size, that's your number one defense. Risking just 1 to 2% of your capital on any single trade is what the pros do. And you can also think about scaling in. Start with a small position to test the waters, and then add to it if the trend proves you right.
Look, at the end of the day, mastering your own mind is just as critical as mastering the charts. You need the patience to wait for that confirmed candle close. You need the discipline to say no when you miss your entry. You never ever chase the market. And maybe most importantly, you have to trust the system. False breakouts are going to happen. They're not failures. They are simply the cost of doing business when you're a breakout trader.
All right, we've gone through all the theory. Now for the fun part. Let's put it all into practice and see how these concepts actually play out on a real chart with some recent examples of both clean breakouts and nasty fakeouts.
Here we go, a picture-perfect example on a Bitcoin chart. This one hits every single rule in our playbook. First, see that consolidation as the channels get super tight? That's our stored energy. Second, bam, there's our break, a massive candle closing way above the upper band. Third, our confirmation. Look at that huge spike in volume right at the bottom. And finally, as the trend gets going, notice how the price keeps respecting that middle line. That's a healthy, sustained move.
Now let's look at this fake out on gold. This is a classic trap. You see the price poke its head above the upper band, and it's so tempting to just jump in. But if we check our rules, the breakout candle is pretty weak. And more importantly, look at the volume. It's actually going down. There's no conviction, zero confirmation. And sure enough, the price gets slammed right back inside the channel, trapping anyone who got in aggressively without waiting for all the signals to line up. And the data really tells the whole story here. In a market with a strong, clear trend, a system like this can perform incredibly well. We're talking win rates around 60%. But put it in a choppy, sideways market where there's no trend, the performance drops off a cliff. And that's not a flaw, that's a feature. It just confirms what we know. The Donchian Channel is a trend-following tool, and your success with it completely depends on using it in the right conditions.
So, after seeing all of this in action, it really brings us to the final and most important question you have to ask yourself. Which type of trader are you? Are you the aggressive one who wants to jump on the immediate breakout and capture every single bit of momentum? Or are you the more patient trader who's willing to wait for that retest to get a safer entry with a better risk-reward? There's no right or wrong answer here, only the one that truly fits your own trading psychology.